unfiltered opinions.
Introduce me.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
I'm Nicolette Mashile.
And I'm Simon Brown.
Welcome to Insider Exchange.
Market Matters this week, we take a look at the Monetary Policy Committee's decision to keep rates unchanged. We take a look at China's GDP output, 4.7% below the 5% level. That is the magic number for China, which is insane. Some delistings in the form of Sasfin and a couple of others, and the Transnet loan. Technically, it's called a loan. But welcome again, and Actually, this is probably going to be one of the best episodes that we've done because the amount of experience that's in studio for those that are listening to the pod, on the other side of the desk, not on my side of the desk, on the other side of the desk, cumulatively, I estimate at just shy of 100 years.
Yo.
So 50, I think it's about 52, 53 years on the one side, and close to about 38 to 40 years.
See, I started as a kid, so I've probably got 40. I started when I was 12.
So we're just shy of an entire century of knowledge.
I wasn't working at 12, although I got to say, if I'd gone to the exchange in Diagonal Street, they would have put me to work.
And if you're wondering who's joining us in studio as the studio guest this week, it is none other than Sasfin Wealth's David Shapiro. You may have heard the name, you may have heard the voice, but certainly those that don't know who that gentleman is should probably not be watching this show. You should probably you have very little knowledge of markets. But Uncle David, thank you so much for coming through. Thank you for giving us your time and for joining us in this conversation.
Well, lovely to be here in Rosebank.
And fancy, eh?
And fancy.
I prefer it to Sandton, actually. I was saying that to Simon. Got a nicer feel.
Much better. Well, Simon lives here, so he's biased to it.
Now I'm talking my book.
I think so. I think the Rosebank has gone up. You know, I'd prefer to be here. Our offices are in Sandton, but I'm going to start advocating change.
and a big part of that was, to go completely off topic, the Gautrain station. Because when I moved to Joburg in 2007, Rosebank was not much of a muchness. Yeah.
And then there was a whole lot of development around the World Cup and all of those things that happened. But nonetheless, with all of those developments, we still find ourselves in a very precarious position as South Africa. The Monetary Policy Committee deciding to keep rates unchanged. It was kind of expected, but at the same time, how much longer is this going to go on for?
It's such a difficult question to answer. Why I say difficult, I don't think the Reserve Bank can answer that. They're also waiting carefully. Sadly, they've got inflation, just still over 5%, which is on the high side, understanding that the rest of the world is coming down. The United States is starting to come down as well. So they've got to be very careful about reducing rates. But on the other hand, we need stimulus. We need, and Simon, if you look at the prime rate, it's 11.75%. No business can function paying those kind of interest rates. So that's got to come down just to give businesses a bit of margin to expand. So I think that's the dilemma that the Reserve Bank finds themselves in. They want to be true, to monetary policy and to inflation theory and so on. But on the other hand, they've got an economy that is swerving.
They're also focusing on the 4.5%. And we said this before about the governor. We're well within the band, but he wants 4.5%. So, which they're going to get to. But there were 2 votes to cut. I think September is the cut date. There were 2 votes to cut. All you got to do is swing one person or to get them to take a day off sick or something.
But with the inflation targeting and the inflation ban in that conversation, at some point, surely we should be having a conversation around the fact that, is this a reasonable expectation? Because I understand that it makes us competitive globally and it looks good to have that inflation targeting ban there. But if one of your biggest contributors towards inflation is the government themselves and they determine inflation policy, surely we must realize that something doesn't add up here.
I know. A lot of our inflation is imported as well. It's beyond our control. So that makes it very difficult. We can't control the oil price. We can't control a lot of the imports that come into the country and so on. Food we could probably control by being a little more efficient. I'm saying farmers, but they're doing as best as they can. But at the end, end of the day, you can't function with rates that high.
Absolutely not.
We need rates. We need the prime rate, the borrowing rates, to be around about 7-8%. Considering where our inflation is, and I'm being very liberal in that respect. We really need it down to 3 or 4 or something there.
Wouldn't it then be prudent to look at the rate at which the banks borrow from the commercial bank? I mean, that premium that sits between the commercial banks and the central bank in other countries is much lower than it is in South Africa.
Okay, we're going to have fun.
Now we're just going to upset some of the bankers.
No, we're going to have fun.
350 points. Basically, they go to an ATM, they draw money, they add 350 points,
and then they give you exactly. And that interim
Is this
premium.
open season, this podcast?
I mean, surely.
Hello.
It's at some point we have to look at what is
Yeah, right.
if we're really in this government of national unity, or what's best for the country and what's best for the people, then everybody along the way, somewhere we must make these compromises, and from a government perspective as well.
A bank make a compromise?
I'm trying.
Jimmy, to be honest, and I think this is a serious conversation. Our banks are incredibly well capitalized. They are ginormous businesses, overcapitalized. They don't take any risk. This is a lovely little business you're running. Go to a bank and try to raise money. You're going to see what they want. You're going to have to, unfortunately, put your mother up for security or something like that, and your auntie and your auntie's family and so on. They don't hand out money easily, and that's a big problem in South Africa. On the VC side, venture capital does not exist because of that. So you've touched, I know we're skimming over it, but you're touching on a very important point here. Our banks, and look at the salaries that the bankers pay themselves as well. You could feed the entire country on some of those executive salaries. So it's a very important point that you brought up, that margin, and can we bring those rates down? Can we make it easier for companies to exist? This is the last podcast I do.
but to the point,
that's going to be another conversation.
Because that 350 point margin probably comes back from way in the day when prime rates were at crazy levels, and it was as a percentage. But now it's like, more than a third of that 1175 is banker margin.
So now we have a situation where your consumer's under pressure. Your bank is saying, oh, no, the consumer's under pressure, but the bank is still comfortable.
Yeah.
The bank is still cushy. But that's another conversation for another day. Because if we go down that rabbit hole, that's not going to end well, right?
That's an important rabbit hole. I mean it. Genuinely,
While we are looking at important rabbit holes, Transnet, they secured a loan from the African Development Bank for 18.5 billion rand. Now, by all accounts, this is a loan, as it's said to be a loan. But the last time I checked, and I've got, again, base level accounting degree from Wits University, nothing against the university, probably just my knowledge. When you have a loan that is backed by the government, you may as well put it on the government's balance sheet and call it a bailout.
Correct. It is. Yeah.
It is. It's a contingent liability.
Oh, there
so
we
in
go.
any accounting, in your accounts, it will appear as a note. And this is the famous Enron. I don't want to say, Enron kind of had, what did they call it? I can't remember the terms, but there were hidden loans. Even Steinhoff.
Yeah.
So this is open. We know it's there, but you have to bring it into account, understanding the country's liabilities and that. So you can't just brush it aside. Where you stand guarantor, you have to make sure that Transnet pay back that loan, because if they don't, as we've seen with Eskom, government comes to bail out, which is means the taxpayers come to bail out.
Yeah.
Very interesting that the financing came through a third-party institution and not directly from the state. And so the state stands by and says, the Minister of Finance stands by and says, no more bailouts for SOEs, but standing as guarantor for things for SOEs is equivalent to the same thing.
So the bailout in SOEs, it depends on what the SOE is. And if it's Transnet, bail away.
We don't have a choice.
Bail away. Hopefully the money, at least some of it, gets spent well, and we can get iron ore to Sishen, and we can get coal to Richards Bay Coal Terminal, etc., etc. It's when you're bailing out, I don't know, like SAA, and I talk my book there because I still got Voyager miles. So. but Transnet's a critical part of our economy, and it is currently broken.
I suppose the optics would have looked bad if you had called it a bailout from the beginning.
Well, particularly because the government has been saying, they're talking tough and bailouts, etc. I mean, they're not really, but because, as you say, it's still on the government books at the end
Jimmy,
of the day.
if you look at Transnet and Eskom, you go back last year and you see the impact that had on the South African economy. And don't look at the Reserve Bank statistics. Go read the mining companies, read what they said about it.
Kumba
how much
this
it
week
cost
said
totally.
it.
Yeah.
In their update this week.
Yeah.
But you need competent people. And we just hope that with this new government, that the people in charge know how to use that money and use it, skillfully.
Kumba has almost a year production stockpiled at Sishen, hot as hell,
That they
because
can't do anything
get it
with
to
because they
coast.
can't move.
Correct.
It's terrible. Speaking of good governance and things that are changing, the couple of delistings that we've had, we don't have much time to get into it, but I suppose I want to look at the obvious one in the Sasfin delisting that's coming up. Uncle David, you've been there for 52 years.
No, I haven't been in Sasfin for 50. No,
You
kind of
have?
that. Well, I started Sasfin
76.
20 years ago. I started at Max Pollock, which became Frankel Pollock, which became SocGen, which became... So I've gone through a few transitions. But I know the Sassoon family well, and this was listed in 87. But the problem is there's a wider problem. And, for small businesses, it's very difficult to get the benefits of a listing, when you're that small. I've tried through the various competitions, and I know Simon is very much in the same camp that I do. We try and encourage young people or just people generally to buy smaller businesses to get invested in that. But unfortunately, we're swamped by the product salesmen, from all the big institutions who come and sell tracker funds and so on. NASPAS, those kind of things. So it's very difficult for some of the smaller businesses to really get the benefits of a listing.
These are the same sentiments that were echoed by Michael Sassoon, and I spoke to him this week about that around it's an interesting decision as well as an asset manager to sit back and say, it no longer benefits us, or the benefits to listing are outweighed by the everything else that comes with it. That's a very telling sign, or a very telling statement of our market in general as well.
But there is. I mean, if I had R1 billion in the bank, I don't. If I had R1 billion in the bank, you could go and buy 4 or 5 little small caps for a couple of $100 million each. Take them off the market and live happy for the rest of your life, because there is quality that is dirt cheap. But if prices aren't rising and some of that were listed in the same period, combined motor holding, I hold it, 15% dividend yield. In the however long I've held it, I think my capital appreciation has been like 12 Rand. But I'm earning 15% in the dividend every year. Grindrod's a bit of an exception. Spur's a bit of an exception, and that's from the same time. Cook's Brothers, which I hold because my nephew wanted to buy a banana farm. Cook's Brothers, I mean, okay, look, I don't like primary agricultural businesses, but just nothing happening. And you got to think that these directors, these boards, these shareholders are regularly looking at this and thinking, why? What is my benefit? The only benefit is that every 6 months they've got to chat to you and me on the wireless, and that's probably not fun either for their
They
job.
probably don't enjoy that either. But also, I mean, if you look at the listing requirements, they're so onerous from a compliance perspective that you sit there and you say, if we're not listed, we save on 1, 2, 3, 4, 5 costs on our balance sheet, on our income statement. We suddenly are able to pass that saving through to our shareholder as a dividend, as an increased dividend, even if it's not every year, but it does add up. If you're listed, you said Sasfin is listed since 87. I mean, if you've listed that long, there's a lot that you've paid to maintain that listing.
For some time, they were well followed. But I think as things got bigger, so they shrank. They couldn't keep up with that kind of growth. The other one was Bell as well. Bell is another business. There's no spending. If you look, there's no fixed investment in South Africa as well. So it became very difficult for them. They had tried to take it off before, in a bit of a cheeky bid, but they were in the same position. They're not a bad business, but you can't see the benefit. The shares trade at such a massive discount to what they assume is the intrinsic value. And intrinsic value, Sasfin shares were trading 17, 18. They're bidding at 30. Now they wouldn't bid 30 if they felt that the intrinsic value was 17 or 18.
That used to be the trade on Sasfin.
Yeah.
When book value was 0.5, buy it, and then sell it at 1. Bella's trading at the same price from 2007. And that's at takeout price, or a little below. 50 Rand, it traded at 2007. The entire 17 years since then, it hasn't traded at $50. And you got to look at that and think to yourself,
we're going to wait another 17 years.
I'm just also, I don't think it's even so much the cost of listing. I mean, that's a cost and it's an admin and everything else. But it's like you're the Bell family or the Sasfin family, and you're sitting here in your investment and you just, you're looking at Jeff
and the market
Bezos
is telling
and thinking,
you that's it. And the market is telling you your investment hasn't done anything
You're
in
looking
17
at Sean
years.
Summers. He gets given 100 million of share options.
What is it, 104, right?
Yeah, of which half of it was for doing an organization little graph.
Organizational chart.
Yes. So you look at this and you're like, guys, it's just like for nothing. For what? This is not creating me wealth. Stock markets are supposed to help flow of capital and wealth creation. And if it's not creating the wealth part, why have you can't issue capital within a share
through
price.
My crystal challenge, what happens is that there are 350 people who chose 5 stocks, and I have to track those stocks. And because of that, it's what I'm trying to say, where I'm getting at, it's highlighted so many small businesses that I didn't even knew existed, that I've been looking into and seen how people have done, how well they've done.
That list as well. I mean,
I never knew something like Core Potash existed, and suddenly here is this business in the Congo, in the old Congo, the old Belgium Congo, not the DRC. And, also a mine in Tabazimbi and so on. Quantum Foods, there's been so much action around there. And to me, it's been very charming to kind of watch these small businesses. And for anybody who's young, who wants to start a portfolio, I think there's some rich pickings still on the JSE.
Oh, yeah. I think there is value there. And I think more delistings coming.
I know for a fact Anthony Clark would agree with that. I spoke to him as well, and he said there's so much value in small to medium cap stocks that we should probably just build a fund for it and go out and buy some of those things. But that's all we have time for in our Market Matters segment. We will dig into some of these other stories at another time. I'm certainly interested to see how we approach the banking conversation, but that's a story for another day. In our deep dive this week, we take a look at luxury assets, luxury stocks, and who better to do that with than one David Shapiro of Sasfin Wealth. The gentleman has more than 50 years of experience, having worked in our industry, having understood companies and following companies, and looking at all of the emergence of new companies, the likes of Ferraris that haven't been listed for too long, against the likes of LVMH that have gone and consumed absolutely everything in their path, and now coming after companies like Richemont. Uncle David, thank you again for giving us your time and sharing your insights with us. Simon and I spoke about this, I think it was a week and a half ago, where Bernard Arnault, the founder of, or the CEO of LVMH, bought some personal interests in Richemont, and we were like, the world of luxury is a completely different world.
Well, it's the world that we can't participate in.
Yes, we look at it through the window. We window shop on it.
Jimmy, I've got a saying that I've been using a long time. I say, buy the shares, not the product. In other words, you can still benefit from luxury by buying the actual shares as well. And luxury is just something that it's not difficult to understand, but it's got its own separate, I don't want to say culture. What is luxury? It's quite difficult to define. I know there are a lot of brands that we think are luxury, but that's not luxury. Luxury.
You actually gave me the best definition of luxury, and I put it in a piece. I put down a little article that I'll share in the link after this pod. And your definition of it was, if the second-hand product sells for more than the primary product or the new product, that's luxury.
Yes, because it shows exclusivity and it shows demand. In other words, the people who are buying the second-hand can't afford or can't get to the new one. And also, the brands maintain their value.
Yeah.
And there were two, how I started to look at luxury, and I was at one of the Buffett conferences, and even though the company I'm talking about is not distinctly luxury, this was after the 2008 crisis. And I was at the Omaha meeting, and a person asked Buffett, one of the members of the audience said, why did you lend money to Harley Davidson? Harley Davidson, because they didn't buy shares. And he says, to tell you the truth, he says, any company that has customers who tattoo their logo on their chest, he says, it's got to be a good company.
It's a loyal customer right
That's
there.
a loyal. And he says, that's got brand loyalty. And I thought about that, and it struck with me. And that's why the two companies we're talking about is one is Hermes. I'm not pronouncing it. Hermes. I don't know that you've got to have the French twang to it.
Hermes. I don't know.
Hermes. They have the Birkin bag, and the Birkin bag comes from Jane Birkin, who was a soft porno star in the 1960s, and we knew her. People of my age knew her, and Sergei Gainsborough, who made this song Je t'aime. But the bag is named after her. She died recently, and apparently she was on a plane, and she was sitting next to the designer of bags and said, I can't buy your bags because you haven't got place for a bottle. She had a baby. And whatever it is, they designed the Birkin bag. The Birkin bag today, and Simon can look it up as we talk now, the second-hand bags, I think, go at almost double the new bags. Now, that means that there's a massive demand for it. It has a certain status.
A pre-owned bag is currently on sale for $37,500.
Careful. Are you looking at a standard Birkin, or are you looking at a Birkin Minis? Because they have a mini range, which is equally as pricey and is half the size of the regular size Birkin. So,
I mean, I don't understand bags. There's some here for 20,000. These things are, they call them, in this industry, they don't call them secondhand. They call them
pre-loved.
But that's luxury. And I think you see the same thing with Ferrari.
Ferrari as well. So Birkin, if you've got the money and you can go to their shop in New York and buy a bag, they will say no. They won't sell it to you. It's that. You've got to join a queue. You've got to wait. Ferrari, if you want a new Ferrari, they might have one on the floor.
You have to be as far as I remember, the rule around Ferrari is you have to be an existing Ferrari owner in order for you to purchase a new Ferrari, which means you have to buy your first Ferrari second-hand in order for you to be entitled to purchase a new one.
They did a special Ferrari, was it 150 of them or something? I forget the exact number. And again, there was some requirement you had to have owned X number of Ferraris, and they sold out in a day. In a day.
So that's luxury. So Porsche is not luxury.
Yeah, Porsche's nice.
Porsche's nice, but
not luxury. No, come on. I mean, where I park in my basement. There are two Porsches within spitting distance. So there are no Ferraris.
So interestingly enough, and I think this is a very important distinction that you make, Uncle David. We look at the value of Porsches, and there are some Porsches that retain value. But when we refer to luxury, it not only retains value, it appreciates in value.
Yeah.
And when you think about it from that perspective, it's very rare to find a Porsche that has appreciated in value. So that does actually explain
There's that guy, Luxity. I'm sure you've interviewed him. He's got a store in...
Yes, Luxity. I've spoken to, and they specialize in the second-hand.
And they specialize in second-hand. And I mean, I've been to their shop in Cape Town. I keep my hands in my pockets because I'm just scared I'm going to touch something and have to buy it. My sister-in-law was trying on dresses. I'm like, it's braver than me. But she has euros. But he makes the point. And I went and ran the numbers, and he's not wrong. The stuff that you're selling, the person who bought it is actually making a profit on the sale. It's like a share. It's not like a suit.
We're talking about the listed luxury. There are a whole lot of others that are not listed as well, where whether it's furniture, whether it's clothing is exclusive, bedding, all kinds of things like that, and luxury yachts, that kind of stuff.
Luxury watches as well.
Luxury watches.
Again,
it's incredible. You know what's odd? When I looked at the Richemont results, Simon, most of their profits actually come from the jewelry side of Van Cleef & Arpels
Absolutely.
and Cartier. And you know that you're not part of it when you're walking down Fifth Avenue or Madison, or you're in Bond Street or the Champs-Elysees, and you walk past a Cartier and you dare not go in because you know the people are going to fold their arms. Don't even bother, you know. They're going to look down at you and put their noses up, you know. So you know which shops to go into as well if you want to. If you want to buy. I must say one thing for Tiffany's. They know you're going to come in, so they have a special floor, you know, where you can go buy a silver disc for cheapies.
Wow. But also, to your point, David, there's levels of luxury. And I always look at LVMH and think it's just too much of a hodgepodge, as opposed to Richemont, which is sort of proper upper end, as opposed to Race, which is probably, so Race, the Harley Davidson code is hog. I mean, like they got their share codes good. You know, Ferrari, Richemont, those are proper luxury. And then you've got the Porsche and the LVMHs, which is sort of tier two.
You're right on that. You know, an LVMH is becoming more of a brand.
Yeah.
You know what I mean? And they creating this ubiquitous brand. I'm just worried they're going the way of Pierre Cardin, who in the 60s, you know, where you could go into OK Bazaars and buy a Pierre Cardin a towel or something like that, which was by his design. He wanted to design for the common people. And LVMH, I think, is going that way. It's still exclusive. It's still unaffordable, but I wouldn't put it in the Hermes class.
LVMH brands. I mean, I've actually been into some of. I mean, I've been into a Marc Jacobs. I mean, again, I kept my hands in my pockets. Tag Heuer. I mean, you know, these are nice, but they're not. You know, they're not Cartier.
But when we look at an LVMH, I suppose when you look at the brands that you'd put them against, we can almost start to rank luxury in an LVMH versus a Kering group in Europe, because the Kering would then have brands like Balenciaga and the Gucci and those sorts of brands.
They've got one, you know, the one they've got, which is quite, is the Benito. What's it? Go through those brands. I'll
Gucci, Saint Laurent, Baguette. I can't pronounce half of them.
Bottega
that's
Veneta.
That's the one as well. Also comes out with very exclusive bags, which has got a very strong second-hand market as well.
So we're saying in the luxury space, though, there's still levels to the luxury. So your entry-level luxury is kind of your Kering groups and now possibly your LVMH. Then a step up from that is where we put Richemont and your Hermeses and that sort of thing. And I suppose ultra-luxury beyond that would be those piece uniques in the watch world where there's a one-of-one, or those things that aren't even available on the market for display and that sort of thing.
If you don't know,
then it's not for you.
Go down to Saint-Tropez or to Cannes or something like that, Monaco, and go look at the yachts. You know, then you'll know the people that.
And I also can't help thinking that higher end luxury, that proper top end luxury, is way more immune to markets, to global crises and the like. Because if I can afford, you know, these Ferraris or these Cartiers or these Birkins or whatever, you know, maybe I'm now only worth 110 billion instead of 200 billion. Whereas the mid tier, when stuff gets top, you know, I don't have to go and shop at you know, I can go to like Edgar's for my suits.
This is an interesting story, is whether whiskey is luxury and whether wines are luxury, or whether those are just bragging, you know, swank.
Yeah, those are bragging. So someone who drinks both, trust me.
And that's the interesting thing, because I did a couple of pieces around sort of the alternative asset space and how do you really invest in these sorts of things, invest in luxury, invest in whiskey, invest in art. And you start to realize that they're governed by a different set of rules. You mentioned, Uncle David, that when we look at the share prices, you can get exposure to these things via the share price. But as Simon rightly alluded to, some of the shares are a premium. I mean, Richemont is trading at a premium, but Richemont losing 27% of its revenues that came from China still was able to pull off very, very stable numbers.
They're catching up. You know, Richemont is actually catching up and pushing hard. If you look at the chart, you know, and that's come through their jewelry side. You know, the watches are are down. I mean, are still there, but it's the jewelry that's exclusive. I mean, those are exceptional pieces that they sell. And you have to be ultra wealthy to be able to afford. I mean, when we say ultra wealthy, we're not talking South Africa wealth. We're talking,
Yeah, I mean, even our politicians can't afford this stuff. There is a top tip on Richemont that Chantal Marx at F&B taught me. Every so often, Richemont just collapses in a heap and loses 30%.
Okay.
Buy it.
Well, to be fair, I mean, if we look at the South African picture, the owner of Richemont is a significant portion ahead of the second wealthiest person in South Africa in terms of net worth. Johan Rupert sits north of 10 billion. The second, and this is US dollar terms, by the way, so times by almost 20 for South African rand equivalents. And the second placed richest South African is below 10 billion. So it is a significant distance between number one and number two. Then.
He didn't get there that easily.
He didn't. The business took over 15 years to build.
Yeah, it took a long time. He started with, maybe he had Dunhill. He had a whole lot of, it started with, you remember Dunhill?
Yeah,
there were a whole lot of floppies in there, but eventually they've kind of tuned it down to where it is today. Very, very good. And a lot of eyes are on Richemont at the moment.
Is that the preferred luxury pick for us? Richemont over the Kerings, the LVMHs?
Over Kering, yeah. I still think Hermes stands out, and Ferrari. And Ferrari. And you can get two in one. You get electric vehicles in Ferrari and you get luxury.
Nobody buys a Ferrari because it's electric. We'll leave it on that. We'll leave it on that. Thanks so much, Uncle David. Thank you for coming through and joining us. It's been quite an insightful conversation, and we look forward to having you join us for many, many more. But that's all we have time for in our deep dive this week. And we move on to investor insights. I can't. Just wow. Men live longer because we do less stupid things after we marry the right partner. Thank you for that, Simon.
And that's why it's important to marry the right person.
Yes,
That's an asset.
What do we have this week in Investor Insights?
So today I want to speak a little bit about something we alluded to last week, investing with debt. So going out and actually applying for an actual loan so that you can buy a stock portfolio.
Yeah.
Is that something that we should be looking at? Should financial services look at that?
So this is a very, very slippery slope, and it's a very interesting conversation because it has layers to it, right? An onion, right? Layers. Lots of layers. But at the very base layer is understanding that debt is risk. Right? Now, there's a saying that the cost of debt will always be cheaper than the cost of equity, which basically means your own 100 Rand, you could probably do better with by borrowing 100 Rand from a third party, paying a small interest premium and putting your 100 Rand into something else. But what we're looking at here is investing or going out and taking out a loan and using that loan to facilitate investments. Your first basic problem there is your repayment. Only ever look at this if you can afford to cover that repayment in your current standard. Regardless of what happens.
So even if it shoots up, you should be able to cover
sunk
it.
cost.
Yeah.
If you're borrowing 100,000 Rand and they're saying that the cost of 100,000 Rand for you on a monthly basis is going to be 2,000 Rand, arbitrary number. You have to have that 2,000 Rand at all times.
Yeah.
No matter what. That's your first tick box. Your next tick box, and this is probably the equally as important as the first one, whatever you're going to do with your 100,000 Rand needs to return you more than what you borrowed. Otherwise, it's a pointless exercise. Because if I'm paying 17% on a 100,000 Rand loan, and I'm using that 100,000 Rand loan to generate 12%. Every year I'm out of pocket 5%. It makes no sense. The whole point of investment is appreciation, not depreciation.
But I would put a third tick box then, which is careful what you buy, because the obvious one is now Jimmy has told you to go, so you go and buy the potash David was talking about, and it goes the other way. You actually want to almost go to a lower risk space. The problem we've got right now is in the high interest rate environment. In a lower interest rate environment, maybe it works. But of course, interest rates can also change. But there's a fun thing here, securities-backed loans. So the brokers start to do this, which is the other way around.
Yes.
So you've already got shares. So your 100,000 Rand, you're not borrowing. You've got 100,000 Rand of shares. And your broker will lend you 20 or 30,000 to go and buy some others. So you're a little leveraged up. Your 100's now 130. But I mean, your first point is absolutely spot on. If you borrow that money, you have to come whatever, Armageddon, you have to be able to make that monthly payment on the loan. Otherwise, you are now in the dwang like you can't believe.
So it's different if you're borrowing money to finance something for a limited period of time, right? This is the other thing, the time component of it. If I'm borrowing 100,000 Rand to finance a project or a development that Simon and I know will return X amount in 36 months or whatever, we've got a finite window on that 36 months. You can measure that return.
It's time-based.
And you can do those calculations, right?
Yeah.
But if you're going to go borrow to be open-ended into Sasol until whenever, you also don't really,
that.
you know what I mean? So
Yeah.
it is something that can be a strategic advantage. And I say strategic advantage because I'll give you a couple of examples. Simon's touched on one with the collateralization of your portfolio, right? It's very beneficial to be able to go into, you've got a 10 million Rand equity portfolio that's sitting with Investec or whoever it's sitting with, and you say to them, guys, I've got 10 million Rand, give me a collateral backed loan of 60%. The bank will never give you 100% backed loan because they're managing their risk. So they're saying, okay, of the 10 million, we'll give you 6 million as a loan. You're still liable. You're still on the hook for the 6 million, but they know, much like a government bailout, they know that if you default on the 6 million, they're going to sell 6 million of your stock at whatever price, whatever price to recover their money. And that's the important thing there is you've got no control over that. Once you sign that over, you're saying, guys, here are my shares. If I fail, you guys do whatever until you recover the money, right? But they'll collateralize the entire 10 million, not just the 6, because they know they can get a worse off price.
And let's be clear, I've worked at a stockbroker where I've had the instruction of that portfolio, sell it.
Liquidate.
I'm like, what price? They're like, sell it.
Anything.
I'm like, but the amount I'm going to get for it's less than they owe you. Don't care. Turn it into cash. So now not only have you lost your money, you now still owe the bank money. And this was back
so
in
you still
08.
owe the difference.
You owe the,
Yes.
And they are, I mean, and you know, it's like, you know, we could wait today and, you know, just like make it cash. We want it. Don't care.
That's it. So when you're looking at this from an investment point of view, it's very important to understand why you want this particular loan, why you want this particular financing, what kind of project it's going to go into. A lot of people will then say, look, again, there are strategic benefits, right?
Yeah.
The benefits are that if I have an opportunity right now, there's an opportunity to go in on a very undervalued stock or a very undervalued company and we're delisting the company, we're buying the company out or whatever it is. We've measured how much we're going to return, but I just don't have the liquidity.
Yeah.
It's a good thing. I can go to the bank and say, hey, give me some liquidity against this asset because that portfolio is then an asset for them. And that's the one side of it. But there's a whole separate side of it where you don't have an asset to put up as collateral.
Which means you're going unsecured.
Which means it's unsecured. You're going in and saying, I want to borrow for the purposes of investing. What are you investing in? If you're investing in property, that could be a benefit. I've seen, I actually have a good friend who went out, got a loan and bought a rental unit, put it out for rent.
What kind of loan? An actual home loan or?
An actual home loan, but then collateralized that first property to fund the second, and then the third, and then the fourth.
Yeah.
And so he's not liquid enough to cover all of those, but he understands that every single month when that monthly premium is due, there is enough to cover that premium. And using debt to finance investments, as Simon rightly said, when it's low risk and you understand what you're doing, then it's okay. But the first thing I said when we started this conversation, it's a slippery slope.
And then it comes to the question, Nicolette. So let's use Jimmy's example where I'm going to pay 2,000 Rand a month back for this debt.
Yes.
Why don't I just invest 2,000 Rand a month? Start slow.
Is my return?
And I remember when I was 20 odd years old and I went to the bank and tried to borrow money and they wanted to know why. And I said, I wanted to buy shares in a tech company.
Yeah.
And they were like, dude, you're still in matric. I'm like, yeah, but like, I know what. Yeah. Anyway, they turned me down. But so what I then did was I just every month put some money aside and it took me a year and I'd saved up some cash. And I know FOMO, we're in a hurry to get rich, places to go and things to do. But it was the low risk route.
Yeah, and it actually also does add up. I think a lot of people think that it's like that 3-year degree. You have a conversation, do I actually want to go and do a degree? And someone's like, just go and do it. And then 3 years later, you didn't do it and you're sitting there kicking yourself. And I think it's the 100%. Same thing with finance. Let's move to the next one, which is quite an interesting one. We are coming into Women's Month in August. That is like literally a week away. And I want to put a gender lens on retirement. I'm finding that women are living longer. So when we all get to retirement, say you and I both get to retirement, we both have saved R1 million. What I get for my R1 million and what you get looks different. And simply because I'm going to live longer. Surely then we should be taking it a couple years back and helping women restructure how much they contribute to retirement correctly.
So let's be clear. I mean, the whole retirement industry, when it started, would have said, what's woman? I mean,
yes, of course. Patriarchy and all was built.
And then one day, the retirement industry was like, oh,
it's a whole market.
But then you're 100% correct, and there's lots to it. So women typically start later. They typically save less because they have more pressure. Let's not even go down the road of single mothers. Who
and salary disparity.
We can pause now because you're getting the message across.
There's a lot,
but we're not even scratching the surface yet. And then you're 100% correct. Then you come to retirement and you think, finally, rid of patriarchy. And the retirement industry's like, we saw you coming. There should be. From a pure numbers game, women are going to live longer. That has implications. It means even if you're not in an insurance product, if it's a living annuity or something like that, your drawdown rate has to be smaller. So there's no looking at the gender in terms of the policies that are being sold, and I think in many cases also in terms of the advice that's been given. It's kind of viewed of, are you going to live for X years? Well, no, it depends if you're male and female, and those numbers are different, and they are markedly different. Easily 5 or 10 years extra life expectancy for a woman. So, I mean, the one tongue in cheek is women should marry very young men.
No, well, what will that do for them?
So what it means is they die at the same time.
Oh, wow. So instead of fixing the numbers, just rather fix this number.
Fix this situation.
No, because you're 100% right. I mean, I thought about it before and I haven't come with this. I don't know what the solution is.
And I guess also when you enter into a corporate world and they sit you down with HR to discuss which retirement, which band you are going into, it's almost a default, right? And a lot of people don't have that conversation to say, well, I'm a woman, I'm this age. Everybody just kind of goes into the default, that the whole company has gone into, never really goes to see HR until you resign or move on to the next job.
Last week, you and I spoke about the two-pot system and how not contributing over the long term has an issue, right? To bring it into this conversation, we've kind of skimmed over this, but there are females that take breaks to become parents.
Yes,
in that time when you decided to take an unpaid break or an extended break, you are now no longer contributing towards those things. Now that in itself has a detrimental impact on what you achieve at the end of it as an outcome of what you've raised, despite the fact that you already have that sort of disadvantage where you start from in terms of salary disparity and all of those things.
You earned this, you took time off.
So taking time off as well. And now you have these conditions all compounding. And unfortunately, when they compound, I mean, if we take a woman who does earn a lower basic, does take the break, does tick all of these things in their roadmap of life, you could find that by the time they retire, they significantly or they earn significantly less than what they would have or than their male counterpart. And that's a serious problem.
And then a corporate kicks a woman out 5 years earlier for retirement, which gives
60, not 65, right?
Which gives her even less. No, not all corporates. Some of them are getting quite woke on this, but most corporates are putting retiring women earlier, which again steals time.
And as we've established, in retirement, time is everything, right?
Let's look at the wall. I want to go overseas first today. And I don't know, there's something that says to me, let's talk Tesla.
Okay.
I've been seeing Elon commenting quite a lot on the Donald Trump shooting and attempted assassination.
So you say commenting a lot. Elon Musk is actually confirmed he will be contributing $40 million
So what?
a month
Yes, and
to
this is
ensure that Donald Trump
and
gets
we have
elected.
the receipts, which also his earlier tweet, which
Per
says
month, 40 million US.
And what's the justification for that?
He believes in Donald Trump.
No, but that can't be all.
this man is so polite. He believes in Nazis.
That's worse.
The right-wing MAGA in America really do think that Joe Biden and the Democrats are coming for their I don't know what, and there is craziness to it. But Tesla's an interesting beast because, I mean, the chart's actually doing quite well. But there is certainly his antics are turning off some buyers. Your typical EV buyer would be, initially in the early days, was a left-leaning Democrat, right? Wants to save the world, cares about the environment and that sort of thing. But there's also just a sense of you're a first market mover, you got 100% of the market. They're now down to about 50%. And that's just what happens. Unfortunately, Elon Musk is something else.
You're still technically the largest player in the market. You're still the front runner. So that whole first mover advantage will still serve you well. I mean, if you think about a Microsoft, for example, you think about an Apple, for example, if you are the first or the leader in certain spheres, it's very difficult for someone to come and unseat you. But this is another interesting stat, and I've given this out as a separate stock pick on a different show at a different time. Warren Buffett and Berkshire Hathaway. Warren Buffett, arguably one of the best investors in history from a long-term perspective. He's backing BYD. He's not backing Tesla. And that's my alternative for you.
It's cheaper, it's Chinese, and it stands for build your dream.
So Tesla, you didn't actually say whether it's a go or not.
That's true. We didn't actually say whether it's a buy or not.
So, I mean, the chart is looking good, but no.
No. Instead, you're buying BYD.
If there's an alternative. No. Maybe we should add that to our wall. Maybe we should add a section for alternatives where there might be a more affordable alternative. We'll look at that.
Okay.
Yeah.
I want to talk Anglo Gold Ashanti.
Yes. Let's talk about it. Let's talk about it. So for 20 years, the only time I bought a gold share was when I closed a short.
Yes.
You
said that.
That's how it works, right? And then this weird thing happened, pandemic. And suddenly I found myself owning gold, physical gold or an ETF, and Anglo Gold Ashanti. These things, so the gold price trading at all-time highs this week. It's pulled back a little bit. My target of 2,500 for this year is just a walk in the park. It's a small little hop from where we are at the moment.
I think we hit 2,480. I'll pull the numbers quickly.
86 or something. I don't know what the next target is because it's the moon. The gold price is not going away. We're in a higher for longer inflation environment. There are phobias and fears out there. Central bankers are buying gold instead of dollars because they saw what happened to the Russian dollar reserves. And so goes the story. And in which case, you need to own a gold mine. Now, I was actually chatting with Meryl Pick from OMIG this morning, and she likes Harmony, partly because of the gold, but they've also potentially got some copper assets. Anyway, Anglo Gold Ashanti, love it, hold it, wish I had more.
Wish I had more. That's
There we go.
Here's an interesting one. I mean, I'm only asking just to hear your sentiments on what is actually happening. Sasfin.
Can't buy it.
Yeah.
They're going to delist. No point.
So anybody who's currently holding it, what does that mean for them?
You'll get bought out. There'll be an offer that'll be made. It'll be made at a certain price. You will have the option to accept the offer or not. If enough people accept the offer, it will be forced upon you to then accept. The company will delist. It will cease to exist on the exchange, and you'll get cashed out.
And do be careful. So the offer's 30 Rand a share.
Yes.
So it's currently trading at 27 time value of money because it's going to take time for the deal to happen. Sasfin might say to you, you can take shares in an unlisted Sasfin. Don't do that.
Right.
Don't do that because you've got no liquidity. You can't buy and sell. You can, but it's immense. The beauty of the JSE is that I could, while I'm talking here, sell my entire share portfolio, have the money on Monday, and be on my way to a hideout in Zimbabwe because no one would look for me in Zimbabwe.
That's a very interesting hideout.
But your unlisted shares, you could spend the rest of your life trying to sell them.
And this is the other thing with the Sasfin deal is they are looking at almost a partial delisting.
Yeah.
And that you can't really do, right? So from a JSE perspective, there's a whole list of problems that come with that. But either way, it would have been lovely to have. But if you didn't get in when did Uncle David say it listed? 1987. If you didn't get in back then, it's delisting now. Ship has sailed.
All right. And the last one, I want to bring back Pick and Pay. And what are your current
Did we not
sentiments?
just do an entire thing on the rights issue last week and Sean
Yes,
Summers? And
yes.
Look, if you have the option to take up the rights, then good for you because you're getting them at a much more reduced price to where the share price is. Share price is back at 22 Rand, having hit 28 Rand this week as well, ahead of the shares. The rights started trading on the 17th, so about 2 days ago. Anything in this 20 Rand range, I still think is worth a buy. At the end of the day, they still have the footprint. They still have everything else. Even if worst case scenario, Sean doesn't implement the management turnaround that he wants to, or the business has to sell off half of whatever it has, at 20 Rand a share, your upside versus your downside, for me, I think they survived their worst, and at their worst, we got as low as 16 Rand. So if you're buying at 20 Rand or even 22 Rand, it's a 6 Rand difference down to where their absolute worst was. And the market then said at 16 Rand that they believe that the stock is still worth something, right? So for me,
yeah, and
absolutely.
the current 20 odd bucks is 2008 price levels. I concur. I think there's more chance of Sean doing a lot of good. He might not get it all right, but he'll do a lot of good. And he's not going to break it more, put it that way.
That's it. He wasn't brought in to break it more, and breaking it more doesn't incentivize him to get paid either, right?
Yeah, absolutely.
Yeah, but a lot of that money is just like, dude, as long as you come to office every so often,
You get your money. You get that portion of it.
Yeah.
All right, so we'll cap it there at our wall. So Pick and Pay is still staying on the wall. Just don't know where it's ranked on our wall, but it will stay there.
You know what? I think we should have it sit as a load up. I
Okay.
still think people should be loading up on it.
Yeah.
I don't yet think it's worthy of blue chip status, but it definitely load up if you have the opportunity to, and see how that works out for you. I mean, at the end of the day, the things that we say here are our thoughts and our
Absolutely.
opinions. You know
Absolutely.
the disclaimers. This is not investment advice. Please don't come back to us and say we've given you investment advice when we
Please,
haven't.
man. And I hear people asking me about my investment firm. I'm like, guys, please, these are opinions.
We have conversations.
any of
we
us
have-
are sliding into your DMs on
It's
the
not
social,
us.
it's not us.
It's not us. Speaking of socials, we are on our social pages, our ex-community pages. We've got our YouTube channel up. We've got our TikTok channel up. We are on our socials, and we do post our conversations there, but we do not slide into other people's DMs. We do not. We also only follow the three of us. If there's an account that follows you, that has our names, that isn't
not us.
one of us, it's not us.
I want to tell you what I want to speak about next week.
Okay.
As we're holding our breaks the 19th of September for the next MPC rate decision.
Okay.
That's what I want to talk about, because I feel like South Africans are under pressure. We're not understanding this inflation adjustment, inflation management. We all think we're waiting for the US to make a decision and South Africa will then follow suit. We need to explain that to people.
So Uncle David's coming back to talk about that banking premium. Until next time, investing isn't hard. Just try it.